you're looking for positivity or looking for encouragement. Temia Brinson aims to educate you, to give you the push to believe, to have the mindset for success. Mindset for success. To have the mindset for success. To have the mindset for success.
Welcome to the Mindset for Success TV show. I'm Temia Brinson, your host, and today we have a very special guest. John Burnett is back with us, and he is the managing director and founder of One Empire Group. Amen. And then also, he is also expert on the economy. We had him on several times, so we're glad to have you back today, John. How you doing today?
I'm doing well, thanks, and good to be with you again.
Awesome. So let's get into it because it's been a lot happening since I last talked to you.
So
In last time we talked, inflation was already climbing up. It was already a pattern. It was starting then.
right.
Now it's enormous. It's at an enormous impact now. Like, it's outrageous. Gas and food, everything is high now. So, yeah. And we talked about this before. I think, I'm not going to speak for you, but I think that the Feds should have moved earlier just to get control of this inflation. But they finally did it. I think it was mid-March, right? About a couple weeks, last week, mid-March, they raised the rates, the Federal Reserve, and then they voted to lift the interest rates, and they penciled in, meaning they scheduled to do 6 more interest increases, okay, before the end of the year. So this has been the most potentially. I mean, when they voted on it, it could be changed. You're right. Hopefully, but it still need to be correction, though. I mean, it's going to be painful, but it still need to be corrected. So, but this is the most aggressive pace. If they go through with the 6 increases by the year end, this is the most aggressive pace that they've done in more than 15 years, right? And they're going to do the process of slowing the inflation. And like I was saying before, they should have started before, but this is going to be a long road. So how do you feel about where we are, as far as inflation, and then going from this point, and then we're going to have to dig our way out of this through the interest rates?
Well, just like most Americans, I don't feel good about it at all at every turn, whether I'm putting gas in my car or picking up my shirts and dry cleaning, which jumped 20%. And I actually prepay to get a discount.
Wow.
So last week when I dropped off my cleaning and went to pay, they when I looked at the bill, it was 20% more. Actually 22%, but let's just say 20% more. So I think a lot of experts are saying that inflation, just on average across the board, can see prices and everything practically jump 20%, and that's huge. So any wage growth that a person may have received either prior to the pandemic or amid the pandemic has already either been eaten up by inflation, or is about to be exhausted. So the standard of living is really not going to increase for many because of that, what I call the hidden thief, right? Where inflation almost acts as a pickpocketer, devaluing your money, devaluing your buying power, regardless of what figures you see on your bank account. It's actually, your money's actually losing value.
Oh my goodness. And yeah, they raised it, or they're going to be raising it 0.25% between there and 0.5%.
Yeah, quarter percent. Well, at a minimum, right? So some of those rate hikes that you mentioned, if it's 5 or 6 times this year alone, it could actually be a half a point. Some of those times. So just people should brace themselves for those rapid increases, right? So, there are some pros and cons, which I'm quite sure we'll get into. But you have to know how to play and how to position yourself in an inflationary market.
Yeah, and I'm glad you mentioned that, because even though I know your expertise is in the stock market, but first let's look at the consumers, because this is the first increase, right, since 2018. So now we're going to get used to seeing these interest rates being raised, and it's not on the consumer, right? The way it works is the Fed can raise it on the banks. This is a banking system, right?
Well,
and then they pass it on to us.
Well, let's say that.
Is that right?
So when you look at it, right, everyone in the economy is going to be impacted one way or another through the interest rates, right? So yes, consumers are paying more. However, businesses will be impacted as well, right? So those who own stocks in companies and so forth, those companies will be challenged with making a profit, just like people will be challenged. Their monthly budget, household budgets will be challenged. Businesses will be challenged as well. And some might actually give forward guidance in the next quarter or two, if they haven't already, tempering the expectations on earnings. So that also comes back to the consumer, right? Because many consumers have 401ks, retirement accounts, and so forth. So no matter where you are, you could be hit as a consumer, as an investor, as a retiree. So no matter what hat you wear, or multiple hats, you're likely to be impacted.
Right. And as far as the consumers, this is going to affect our borrowing costs, right? Our borrowing, as far as our mortgages, our homes, our cars, personal loans, even businesses loans too, right?
Well, let's start off with a positive note, right? so when the Fed raises interest rates, right, like they already have done, and will do several times this year, your cash. So let's think of it as deposits, cash deposits, or let's say even CDs, right? They will begin to earn more interest.
Okay.
So that is a positive. However, as I try to educate my students at NYU, because I'm an adjunct there, as well as teach a couple classes every once in a while online at Hampton, and just my constituents here in New York and so forth. And when I post on social media, I try to educate individuals that you should always try, yes, to keep cash savings, but you should make sure that you are making other investments, and those investments try to position those investments, because there's no guarantees in life, but try to position those investments to outpace the cost of money, right? So you're looking for that return. So what is the cost of money? Cost of money are the things that you pointed out, right? Borrowing, in terms of car loans, in terms of mortgages, in terms of credit cards, right? The cost of money. So if the cost of money is anywhere between, let's just say on average, 5% all the way up to 19.99% on some of the credit cards, if your credit is not that great, right? So let's just deal with that range, 5 to 20%, right? So that is the cost of money. and your bank account, you're just solely focused on savings, right? So let's say before year end, with all of the interest rate hikes, your cash might be, or your CD might be earning 1.5% to 2%. So you're earning 2% on your money, but inflation is off the chain percentage wise, right? And then you're not investing, so you're losing out on the potential to outpace the cost of money. So that's huge. That's just based upon, even if your credit is great, let's say 750, 800 credit, you're still only earning about 1.5% to 2% after those interest rate hikes. But then the cost of borrowing is still there in terms of the cost of, whether it be you're thinking about a home equity line of credit, whether you're thinking about refinancing, whether you're thinking about all these different things.
Yeah, refinancing right now is pretty good. It should be. If you're not in a fixed, if you're an adjustable, you probably need to switch to a fixed right now. So
right, but if you don't do it right now, right, 6 months from now, 12 months from now, after those quarter or half point interest rate hikes, it's going to be a lot more money.
Yeah.
So investors need to think about money on a time. You should always think about money on a timeline.
Right.
What it is today, how much is it going to cost you tomorrow, and how much you expect to earn on your investments tomorrow, so to speak, right? So that's very important. So likewise, businesses, their cost of capital is going to be more in the form of short-term financing that many businesses seek to facilitate their operations, or more longer term in terms of bonds, right? Mm-hmm. So even borrowing from lenders like those who purchase bonds, that's going to cost them more money, because as interest rates rise, they would have to pay more interest, just like banks would be paying more interest, right? So lenders are expecting to receive more interest for their money, whether it's a bank or whether it's a bond, anticipated bond holder. So the cost is going to be more. So even if you're an equity holder in terms of stock investor, again, the cost of capital, borrowing on the bond side, that is going to have potentially an impact on earnings. So companies are going to look at ways to reduce cost and operate. And let's be honest here. We're also seeing wage inflation, right?
But isn't that going to switch though once the another rate increase and then another rate increase, because these businesses won't be able to borrow what they was borrowing before.
Well, again, that's borrowing. Borrowing costs will be high, right?
Yeah.
But in terms of wage inflation, I remember seeing something a few weeks ago, Target saying that their salaries might go to $24 per hour. That's huge, right?
That's not going to sustain. That's not going to sustain in this environment.
What I'm saying, even in the short term, it's going to exacerbate the inflationary climate, right? Yeah. And that's going to impact what the Fed does and how aggressively and how high they raise interest rates each time. So the consumer, those who are buying goods, are going to feel it across the board in everything, every market, right? But at the same time, that there are also concerns in terms of wages and people getting back to work, because President Biden even mentioned during his NATO meeting that he's trying to warn individuals that there might even be a food supply shortage.
Oh, wow.
So when you factor in inflation,
that sounds like a good stock market, though. I mean, That sounds like good. Okay, go ahead. I'm sorry.
Well, so when you talk about the general inflationary market,
Mhm.
and we'll talk about what's driving that. And then when you talk about the increases in terms of the energy policy, even before the Russian Ukraine war,
Right,
when
right.
you factor in, there's still some supply chain issues with
Mhm.
regard to the increased cost of labor, the increased cost of energy, and not all the people, the workers, so to speak, are back to work.
Right,
So
right.
these are huge complications that's going to create not only higher prices, but ongoing shortages with food and other essential items. So we need to look at this thing holistically and try to, like you said from the outset, the Fed should have acted on this and anticipated this
Yeah. Mhm.
long ago. They should have actually put in several rate hikes
Mhm.
in 2021, so that way it would already been built in, baked in, and
Right.
the politicians, both at the local, the state, and again at the federal level, should have actually reduced some of their COVID policies in the areas of mask mandate, but mostly the vaccine mandate. So that way people start getting back to work. Because
Yeah,
when
and I think a
for work,
lot of
problems.
yeah, but I mean, it's coming back. It's just in a different form because a lot of people are working from home now, and they're not going back into the physical buildings now. So it's coming back slowly. It's just not coming back as quick enough to keep up
Well,
with the inflation. Like it's offset.
well, what I mean by coming back is a little different than what you mean, but there are essentially two ways of coming back that we need to happen. One, people who aren't working at all, they need to get back to work.
Yeah.
Two, those who are actually home working, we need many of them to actually get back in the office physically and do that work.
Oh no, I'm
Why?
not. No. I'm not
Well,
going back
well,
in the
well,
physical building. No,
well, well,
sir.
well, let me finish here. So it's important for people to understand the impact, right? So if people don't go back to work, a lot of those businesses who have long-term leases, not just real estate, but the local
Mhm.
eateries, all the businesses around those 9 to 5 type of work environment or business districts,
Right.
they're likely to go out of business. Like even
Oh,
here,
you mean from the traffic? Okay, I get you now.
right?
I'm following you.
Because if people that are normally spending money between 8 and 7 p.m., because many people spend money after work, whether it be going shopping or whatever the case may be, right? I'm not just talking about the lunch and all these other small errands that people do during the day, and including their breakfast before they go into the office. But those are huge economies that might actually end up collapsing if people don't get back to work. So it's not just the real estate and everything
Mhm.
else. That's a huge shift in spending.
Right. Okay,
So
I get you now. You mean in the
look at this thing.
physical?
We have to
Yeah.
look at this thing holistically, which
Hmm.
again, we should have. Local politicians should have scaled back on many of these restrictions starting in the early part of 2021. So that way, the restart of the economy is picked up. So that way, when 2022 comes around, things should have been relatively back to normal. But we're still seeing local economies trying to bounce back and get acclimated. So it's going to be
Hmm.
a huge. It's going to be very interesting to see how many of these businesses end up surviving, And if landlords, both on the commercial and residential side, are willing to renegotiate leases, but many of them have
Probably not.
outstanding loans and things of that nature.
Yeah.
So this is going to this is not as easy fix as many people might have thought originally. But we need to go back to why we're experiencing this inflation and what really drives inflation fundamentally. So when you look at over the last couple of years,
those stimulus packages. I'm sorry.
exactly, we spent $5 trillion,
Mm-hmm.
$5 trillion in that short period of time. So what does that mean? That means $5 trillion is in the economy. And
right, without any interest rate.
And if you have less,
recouping any of that money.
well, if you have, well, really, it's really supply and demand, right? So when you have all that cash chasing few goods, that's going to actually cause inflation to rise. And that's why we've seen it rapidly. Then on top of that, when you have bad policy, like stopping the Keystone Pipeline and Dakota Pipeline and implementing other regulations that would
to be energy independent, right? Yeah.
Right. So that reduced our level of energy independence.
Mm-hmm.
So then we're subject to foreign oil where we're not a net export of oil. That's going to add a whole nother layer of inflation. And people should understand the impact of higher crude oil prices. One, not just gasoline and home heating oil number two, right? Not just jet fuel in terms of higher cost in terms of airlines travel, but also synthetic fibers, all plastics. Use petrochemicals, right, that are derived from crude oil to make those plastic and synthetic or artificial fibers that goes into clothing, goes into rubbers like plastic containers or tires or things all these things are derived from crude oil that goes. So those are manufacturing inputs, hence the rising cost. And then when you again layer it, all of that, right? $5 trillion in the economy, bad policy, right? The cost of production of goods, then wage inflation. That's why we're seeing 20%.
Yeah, that's a recipe for disaster. Yeah.
It could possibly go higher. And let's not forget, a lot of people haven't paid their rent, both commercial, they're struggling, and residential. So we have some bubbles, and student loans haven't been paid back, right? We're seeing more issues in terms of car loans and other, payments, right? So we got to get the consumer back to work. We have to get businesses with steady traffic and flow, and at the same time raise interest rates to try to balance things out. But this is not as easy. That's why we should have started a long time ago. And now President Biden just mentioned yesterday that we should expect food shortages. So think about the psyche of the consumer.
Yeah.
Hearing food shortages, I have to not spend as much. In some respects, that might be good, save your money and so forth. But if people aren't spending as much, then that's going to have an adverse impact on the stock market, right? Which will impact companies in the stock market and all those other companies that are not even on the stock market, because generally people are more tight with their spending. At the same time, these costs aren't going away, both wage costs as well as supplier costs, as well as energy costs. So, this is not easy. And people like you and others don't want to get back to work. They like to stay home. And
I mean, look, I hear you. However, the whole economy is not on me. Okay, I have to do what's good for me. And plus, I support Uber Eats and that DoorDash. It might not be the traffic in the mall or your neighborhood shopping center, but I support other. They get my money. So I think that it's coming back. It's just a shift in how it comes back.
yeah,
That's all.
yeah, you're saying that easily because you don't own any businesses or any real estate in those business districts. And I'm not just talking about New York City. I'm talking about, business districts all over this country.
Well, Florida is good. We're fine over here. because DeSantis
Florida,
opened it up pretty. Yeah, he opened it up pretty early. So
But Florida doesn't make all of its own goods and services that its residents consume and buy frequently, right? So it will impact Florida one way or another.
Okay, I hear you, but still,
and let's face it, a lot of it is going to come back on the taxpayer. If the tax base shrinks, if the tax revenues shrink, right, that's going to come back on the taxpayer.
And Social Security and all of that. Yeah.
So
like a waterfall.
For entitlement programs, but also just overall fiscal budgetary concerns, right? Things that needs to be paid for in terms of sewage and roads and all these different things. So it comes back on the taxpayer, not just at the federal level, but at the state and local level as well. So even though certain states and municipalities did not shut down, they're still going to feel some pain, just like they're feeling it at the pump, right? They're still going to feel some pain. Why? Because it's America. We're all in it together.
Yeah.
Right? We all need to eat, need to buy things, and we're all going to be hit with those with the rising costs in all those categories.
Okay, so we can kind of prepare a little bit by shifting from adjustables to fixed and try to get that taken care of right now. What about savings? Because I know we probably won't get that much of a bang from interest-bearing accounts right now. So, but I read that online accounts is doing 3 times as better as your brick and mortar.
Well, I'll say this, right? Again, it's important for your viewers to understand money, right? And understand risk and try to balance that. Again, let's say interest rates go to 1% in terms of what banks are going to give you after a year for having your savings on deposit, 1%, right? Mm-hmm. And if you generate a certain amount of interest within that calendar year, right, then they'll issue you I think it was a 1099 INT, right, interest. So that way you have to pay taxes on that, right? At 1%. So that brings you, let's say you have to pay 0.25% tax. So you're really back down to 0.75% that you're actually realizing.
Yeah.
Hypothetically. But yet the cost of money, right, as interest rates are rising, the cost of money, right, is going to cost more. So people are going to slow down their spending. Because like I said before, there's a lot of money, $5 trillion extra in the economy. On top of that, interest rates are rising, like I said, and there's going to be food shortages and things of that nature. So people are going to think, well, wow, I need to slow down my spending. I don't know if I might be let go, because usually companies tend to find ways to reduce costs. They're already trying to automate. Certain people are not coming back in the office, right?
Yeah, their highest expense
There's a
for a
lot of
business is
decisions,
the employee. Yeah.
a lot of decisions being made, and
Mhm.
consumers will have reasonable fears and concerns when they see the food shortages, when they see prices going higher, and all these other concerns, and the tightening of credit. I think that'll actually slow down and begin to not only harm consumers but also harm companies. So it's almost like a downward spiral thing that
Yeah.
might happen. So it might hurt a little bit in the short term before things begin to normalize.
Wow. So, okay. So savings don't sound promising.
Well,
What about
I'm just
putting
saying,
your
like,
money in money
don't
markets?
get your hopes up too high on 1.5%
Yeah.
interest when inflation is at X%, which far
Yeah,
exceeds.
and then you got to pay taxes on it too. So,
Right. The cost of money is much higher. So the thing is, it's if it's within your viewer's risk tolerance, look into investing or possibly buying bonds that have a
yeah, I was going to ask you about that.
AAA rating, because like I said, as interest rates go up, the cost of borrowing from bondholders or anticipated bondholders, that is going to spike higher.
Yeah, yeah. That's what I read. I read that.
And if I can sneak this pro tip in here, if you actually buy in-state municipal bonds, right?
Oh, yeah, you're big on that.
In-state municipal bonds, let's just say Florida state bond, I'm just throwing a hypothetical out there.
Mhm.
An in-state municipal bond is paying 6.5% interest, and let's just say it's AAA rated, right? This is a hypothetical. So it's lower risk, not zero risk, lower risk.
Well, I mean, it's better than 1%.
So it's conservative, right? Not only is it better than 1%, but the kicker is you don't have to pay federal taxes on it. You don't have to pay state taxes on it, generally speaking, right? So
Right.
why? Because you're buying in-state, where you live, in-state bonds.
Mhm.
So technically, you're getting financial education.
No.
Shows like yours. Rather.
Yeah, I think well they're pushing it though, and I think DeSantis is looking at not to get too political, but I think he's pushing financial literacy to be taught in high schools now.
Yeah,
so I'm like, okay.
The only thing I disagree with, I think it's a great policy. The only thing I disagree with, or think that should be added, is that we need to start earlier. High school is late. We need to build up not only the skill set, right?
You mean in elementary? Because
correct.
Middle school is a transition. That's a bad time to get kids.
I think we need to start much earlier, right?
Okay.
For two reasons. One, so that way they build on their skill set, right? And it becomes secondary. And then they start making decisions and start digesting information and making different choices that will lead into different habits, different behaviors. So it's the skill set as well as the behavior that we need to mold and shape differently starting at an earlier age.
Right. So yeah, okay, I can take elementary. So and then you're saying like building blocks, like every year they build on different principles. Okay, like math.
I think we should start at the very beginning. If you're going to teach 1 + 1, put it into context. If Joey has $1 and his mom gives him another $1, how many dollars does Joey have?
Exactly. Okay, you sold me.
It's not just saying teaching it, it's also how we teach it.
Right, right.
And then when it's
Wow.
time to learn fractions and decimals, right? Well, if Bank A is paying 5% and Bank
Mhm.
B is paying 6.5% for the same savings account, which bank should Joey or Sarah deposit their money?
Exactly.
And
Wow.
then how much will each bank return on an annualized basis, right? So we can put it in these word problems and in the teaching methodology, right? So that way it becomes real and practical. So not only are they becoming more financially literate, they're
Mhm.
also being taught how to apply those skills, hence influencing behavior.
Wow. Well, yeah, you sold me on that. I'm sold. Like, because I never thought of at the elementary level. I'm like, how can they consume all of that information? But you're right. It's how
Right.
you present it and how you introduce it
Right.
in the early stages. Yeah.
Absolutely. And
Okay.
interest in return is not a bad thing, right?
Hmm.
People see it as more of a negative thing. Why? Because they're on the wrong side oftentimes, where
Right.
they are on the getting a 0.5% return on savings, but yet paying 13, 15% on credit cards, paying 8% on car loans and things of that nature, right? So the cost of money far outpaces in ways on the actual return on money. So
Hmm.
so so people need to start thinking about investing into real estate, not just sitting on that real estate, but figuring out how to create cash flows so that
Right.
it pays for itself and they're getting a return. Or owning a business, hence generating income, right?
Hmm.
That goes to the bottom line. Or if you don't like real estate, or if you don't like owning a business, at least start investing into the stock market. You could
Hmm.
start off by buying not risk free, but safer bonds that have a AAA rating that are paying a great percentage rate, like I mentioned, in-state bonds and things of that nature. So
Yeah.
they can start there before they start investing into stocks that can get them a return to at least try to earn money
Mhm.
at the same rate or try to surpass the cost of money.
Right. Right. You know, I've been doing good so far because I've been watching. Because the market's real volatile now, and but I mean, I guess because I consume so much news, um, I've been doing energy. It's some funny you mentioned that energy and gold, not food and energy. I know you mentioned. I'm gonna go back and look at food though, but I've been doing energy and gold, and
The gold is like almost $2,000.
man, I'm
And
like.
energy, even before the pandemic, many of these energy stocks, right, oil companies, they were
Mhm.
already yielding anywhere from on average 3 point. I should say on average, but generally, like the few that I like to hold and look at, 3.5 as high as 4.5% yield. So you have
Yeah.
the opportunity for the stock price, known as capital appreciation, to go higher, right?
Mm,
But in the meantime, your yield looks pretty good at 4%.
yeah. Yeah. And then not only that, because I have to now I do flips now because the market is too volatile for me to just stay in it that long. I don't stay in it too long because it go up and down. So I just watch it and ride the wave really. But I was about to say, oil and the gold, those like when the market been all the way down, when you see on the news, like I watch CNBC, oh my God, they're like the world is gonna end. This is the third day it's been down. I'm like, child, let me go get some stocks right now.
So
And then next thing you
buy
know, 2 days later, 1 or 2 days later, it come right back up. Like that's a quick dollar. I'm sorry. I'm not giving no advice to anybody, but I'm just I guess I'm excited.
Well,
because,
I think people should understand who they are as an investor, right?
yeah.
So just like, I like to compare love and money, right? A lot of the principles between, of love and principles of money are fungible. What do I mean by that? Before you get into an intimate relationship with anyone, you need to know who you are as a person, right? So just like money or investments, before a person jumps into a particular investment opportunity or want to explore investment opportunities, they need to know who they are as an investor.
Right.
People need to know that. So people need to consider, risk tolerance. Are they conservative? Are they a conservative investor, moderate, or an aggressive? Meaning that they're willing to lose some potentially, right? If you don't want to lose any, then you're conservative. So it's really a risk tolerance, knowing and understanding your risk tolerance, because that needs to correlate to your investment objectives. Whether you're
so now if you are someone who can't take like the ups and downs and don't do what I just said, okay?
Right, exactly. Don't follow the host, right? When you're trying to keep most of your money.
But I only do a portion, John. I've only been doing a portion. I don't, because I don't like losing money either. So I've been doing just a portion. But I was just saying, because the market is so volatile right now, like I've been doing like quick wins. You know what I mean? So, but I'm not leveraging a lot of money though.
But quick wins. I mean, again, that's more that's some people might construe that as gambling. But again, you got to know who you are, right? Because this is not speed dating, right?
Yeah,
you have to know who you are. You have to know who you are, right? You don't just want to go into a bar, get a quick drink, right? You want to make sure that you understand who you are as an investor. So the risk tolerance, conservative, moderate, or aggressive. And then if you're a conservative investor, you probably want to focus only on lower risk, income generating products, which generally,
like
if it's no risk, then it's going to be really low returns. Moderate might be a combination of income and growth, right?
Right.
And then aggressive usually is a very small percentage of income, if at all, and the majority of it would be comprised of equity type of investments or even more riskier investments. So it really depends upon the risk tolerance, investment objectives, as well as your time horizon. Now, if you need this nest egg, whatever amount of cash you have, because you have plans for it, whether it be retirement, whether it be buying a home in X number of years, education, whatever the case may be, based upon that time horizon, whether it's a year, 2, 3, 5, 10, whatever it is, that should correlate to whether you're conservative, moderate, aggressive, as well as income, growth, or more of aggressive strategy. So people need to understand who they are, do some research on that, and then second stage, because it could be a little intimidating and trying to understand where do you get on the investment ramp or highway. I like to say just start with what you know. If people shop online, right? They shop Walmart or Amazon, and guess who's delivering those packages? We know the federal government, Postal Service, they deliver goods, but UPS as well as FedEx. If you invested, just basic stuff that people understand, right? Walmart jumped significantly, right? UPS and FedEx are off the charts. They made more money during COVID. It's insane. So even if you would have invested in what you know in simple things like that, because there are no guarantees, you would have actually had a great return. Not you, but I'm just saying your listeners.
Oh yeah. I mean, and as far as opportunity, I still think you should not quick wins. I'm sorry, but I still think you should look at the trend. And I hate to mention this, but it's something about history. You know, when we're in a time of war, and most of the money that is made is during those times because a lot of manufacturers being employed, a lot of supplies are being employed, like the oil now. That's going to be high in demand. That is going up because of the demand. So, I mean, I hate to mention that, but it might be good to follow the news just to see where you need to put your money right now.
Well, I agree, but it also is not just listening to the news for the sake of being knowledgeable, but understanding what the news is actually saying, right?
Mm-hmm.
So again, going back to, let's say, 2020, they initially said 15 days, right? Then you could see, okay, this thing is going to go for at least 6 months to a year. At that point, if people are staying home, right, working from home, they're consuming more, right? They're actually buying from fast food or other types of restaurants or as well.
DoorDash,
UPS, things that nature. When you hear news, right? Let's say there's an outbreak today. We have to shut down. This shutdown might be at least 6 months. Okay, what does that mean?
Everybody gonna be ordering in shipments.
How are consumer behaviors? How will they change, and what does that mean? Right? And then which companies are best positioned to take advantage of that? Not take advantage, but will actually receive more orders, more spending from consumers, hence translating that into higher profits and potentially raising dividends in the process. So it's listening to news, listening to events, like you just mentioned in terms of wartime, right? So if NATO decides to say, you know what, I don't want to get political, but maybe maybe Trump was right years ago, and Russia is a threat. We need to start buying more fighter jets. We need to buy more bombs, more missiles, more different things of that nature, right?
Beef up our military.
So that means, right, defense contractors will likely receive more orders. That might be another space people would want to look into.
Thank you for saying that. I tried to articulate, but it just didn't come out.
No problem. So it's really understanding the news and what that actually means. Now, it works in reverse, too. When you hear certain news, how does that impact the stocks that you already own? And maybe perhaps you should think about an exit strategy or repositioning. And what we mean by repositioning, getting out of one and going into another based on the news. And again, I'm not talking about news that will only provide an impact for a day or two or a week or a month. We're talking about impact, over an extended period of time.
Yeah, and then also, this one more thing, because I know you have to go. This the housing market. You mentioned this before, but I think I'm going to watch it because I think it's going to be a good opportunity if you have the funds to clean up. You know what I'm saying? Because it's going to be what I think. I'm not predicting or anything, but I feel it's going to be a time where these landlords are going to want their money. You know what I mean? And foreclosures are probably going to happen. And then if you have the money and you're in the right position, you may be able to do some good deals and investments in the real estate. because the housing market, especially when the interest rate's going up, that's going to be, less competition. Before it was like a bidding war where you can hardly get the house here because you got like 20 or 30 bids on the same house because the interest rates were so low. Now,
well, you have to make sure that, the opportunities might be there, or things that look like an opportunity. But what you want to make sure, and all investments have risks, right?
Right.
But you need to make sure, as I like to say, that the quality of the cash flows are there, right? Not just look at the opportunity in terms of how much it costs and the financing options, but let's say if there's a owner that wants to get out, if half of the people are paying rent and the other half aren't, there's a cost associated with whatever the situation that's going on with the other half of those individuals. Now you live in Florida.
Oh yeah, you're gonna have to put the money in to do the eviction and all of that. But
right, so
you got to put in work to turn it around and get a good tenant in there. But I feel like it's still going to be a good opportunity down the road.
So all I'm saying is that planning is key, right? So again, just like, hey, love and money, right? You just can't think about the marriage. You got to think about everything else that goes with it. Buying a house. So it's effectively planning and projecting out, right? Making sure you have enough cash to float things to make sure that it can get to the point where it's quality cash flows coming from the renters.
Okay. Awesome. So before I thank you for coming on, because this was much needed. People don't know what to do. The market is, some people think it's going to crash. And then 3 days later, it's back up again. and then we're in war, and what's going on with this oil is crazy. And then we're in inflation, and then the job market too. So it's all like a big recipe that's about to explode. So people don't know what to do. So thank you for coming on. And but before I let you go, is there anything you want to say or announce?
No, I think that I just wanted to announce and just say that I appreciate coming on your show each time. I look forward to possibly even doing it at least quarterly because this is going to be a bumpy ride for 2022. Yeah. And as we get on the other side of July 4th. That's a time that we continue to assess 2022, but we begin to look at 2023 and see what that looks like. As we move through the weeks, the months, and the quarters, and so forth. So it's very important to project, that outlook and what we need to consider going forward, especially given the fact that the Fed is thinking about issuing its own digital currency. I know you like to talk about.
I saw that, but I'm still
things of that nature. So there's a lot to talk about there. And if the Federal Reserve, which is the U.S. central bank, decides to issue a digital currency, right? And we know that all of the central banks around the world are interconnected, and there's only 3 countries, I believe, that don't have a central bank. So most countries do. What does that mean? Will they all adopt the same digital currency? Hence, we don't need fiat currency anymore. We don't need to worry about currency exchanges anymore. Will that normalize the markets domestically and globally? There's a lot to discuss there. I hate to leave your viewers hanging on this. But,
I mean, yeah, I heard about that too. I was like, nah. But then again, if it's the government and it, well, the feds. I mean, I think it might be promising because
it'll be less.
Looking at what happened with the Ukraine, they don't have access to money now, so that's a real problem. But if you have an element that's digital, that can open up a whole world. It probably will open up a whole world, and they don't have to go through banks. Banks, the whole system is going to change.
Well, we don't know how that'll change. We know digital currency that they're thinking about, but all these different things in terms of infrastructure, right? Just like people are talking about the Green New Deal and creating electric cars and only having electric cars by 2030 or 2035 or whatever the case may be.
That'll
We
never
have to
happen.
build
Not only
infrastructure
them.
for that, right? So
Yeah.
gasoline powered vehicles, there's already a infrastructure for refueling. Right now, no one's talking about. They're talking about the plans or the aspirations to go 100% electric vehicles by X year, but no one's talking about what that national infrastructure looks like.
Yeah, because it's not going to happen. Okay. Yeah, I don't see that happening. I mean, the oil industry, they will do clean, they will do real.
But policies are hurting our pockets now based upon
Yeah.
aspiration.
Mm-hmm. Yeah. I'm adding a segment where I'm doing announcements. So let me just go ahead and put this up here. So you guys, I want to remind you to pick up my planner. I have a financial goal planner. It's called the 12-month financial goal planner 2022.
Awesome.
I will be coming out with this every year to help you plan for your financial goals. And it has biblical scriptures. Every month I come out with a biblical scripture, also with quotes to build your faith as you pursue your financial goals. Okay. And this planner is designed to motivate and inspire you, put you in a money mindset so you can start planning out your financial life. We want to empower you. Okay. Every month I come out with a financial lesson. I set you up with action plans. You set up your own financial goals, and then you map out your action plans. And then I also have a debt payoff tracker, so you can start tracking paying off your debts. And I have other tools and worksheets in there to help you on your journey. So be sure to pick that up at Amazon.com. You just type in my name, Temia Brinson, Temia Brinson. It'll pull up all of my products. I have previous books in there. But this one is the 12-month financial goal planner 2022. You can pick it up at Amazon.com. And Dr. Keita Joy, she's a dynamic speaker. If you haven't heard her, you need to go to this event May the 7th. It's Women on the Rise, and it's called Release to Rise. Yeah. So go ahead and attend that if you can. And again, Pastor Thomas Ware, May the 22nd on the Faith and Mental Health Tour. And the Church of God in Christ, 72nd Women's International Convention. It's going to be right here in Orlando, Florida. May the 30th.
He's going to make sure I'm on that.
Yeah.
For one of the nights.
Yeah, May the 30th through June the 3rd.
Awesome.
So Women's in the 72nd Women's International Convention. Be sure to make that again, May the 30th through June the 3rd. And you can purchase do your registration at kojic.org. Kojic.org. Okay. And anyone in the audience, if you have anything you want me to announce, again, I'm adding this segment at the end of the show. Just go ahead and inbox me the flyer so I can go ahead and put that down for the next show's announcements. Okay.
Awesome.
Well, we're going to pick this back up later about the digital, because now you got me thinking. I did read that though. I was like, okay.
Totally.
We shall see. All right. Well, thank you for coming on, and I appreciate it. You are such a valuable to not only to not only us, but to the kingdom of God. You don't know it, but you are.
I appreciate that.
Okay. Well, thank you for coming on.
You have the mindset for success. If you're looking for positivity.